Welcome. My name is Tim Jenkins, Principal of Trinity Family Wealth Advisors and Dealing Representative of Capstone Asset Management. Welcome to our fourth quarter video update for the year 2022. I'm pleased to be joined by Glenn Murray, Chief Investment Officer of Capstone Asset Management. Welcome, Glenn.
Thank you.
It's been another eventful year. Inflation is still front and center on everyone's minds, and we have been in a rising interest rate environment for quite some time now. What's in store for 2023?
I'm not one to pretend I have a crystal ball. Rather, I believe it's more effective if we look at what we do know, and that will help us to put some context around what could happen going forward. But 12 months is a long time with the pace that things change in the world these days. So to begin with, as inflationary pressures and interest rates are country dependent, particularly the core CPI, let me focus on Canada as that is the most relevant to our daily lives. If we look back at 2022, inflation appears to have peaked in June when we hit a rate of 8.1%. Since then, it has been trending down with December's year-over-year rate at 6.10. Now, obviously, this is still high relative to Canada's recent history, but clearly we're moving in a downward trajectory. Looking at commodities next, they were a significant early contributor to inflation, particularly after the war in the Ukraine broke out. This market peaked in March with the year-over-year growth rates continuing down throughout the year end. So another key contributor during 2022 was supply chains for all types of products that we heard constant updates on. We all remember the days of the updates on ships sitting idle off the coast of California. Well, today the cost of shipping has dropped dramatically and in fact is now back to 2018 levels. So further to this, we've seen a broad easing on supply chains, which will reduce their inflationary pressure. So one often overlooked contributor to Canadian CPI has been the impact of interest rate increases by the central bank on mortgage rates. In Canada, 30% of CPI contribution comes from real estate, and mortgages are a key part of that in the Canadian CPI. This has meant that as the central bank tightens rates, they were actually contributing to the overall increase in CPI and quite significantly. So now with the recent increase of 25 basis points in January, the central bank appears to be indicating they will be pausing the rate increases. If they follow through on this, it will limit the impact of real estate on inflation. Finally, and without getting too technical or long-winded, we know that in the early months of 2022, the month-over-month growth rates of CPI were very high, which were the key contributing months to reaching that 8.1% peak in June. So as we enter 2023, if the first half of the year's month-over-month growth rates come in lower than 2022, then we will see CPI coming down as the lower 2023 numbers will replace those higher ones from 2022. However, every year can produce unforeseen shocks, like in 2022 with the war in the Ukraine, which had serious implications on inflation, and those cannot be predicted at this point. So while I don't believe we know the future, I do believe that with the review of these items I've mentioned, which reduce inflationary pressures, then inflation should continue trending down over the coming months and be lower come the end of 2023.
Glenn, I've got a two-part question. How have Capstone funds been impacted both by rising interest rates and continued market volatility? And what's been the strategy of the investment management team in these challenging times?
The investment management team sets up the holdings within our funds to provide the best opportunity for the fund to achieve its target return each year. This means that we look to have a well-diversified portfolio of investments within the asset classes appropriate to each strategy. However, every year we have to manage the funds in light of the environment we find ourselves, and 2022 is definitely a more challenging environment than usual. All our funds were impacted to varying degrees by rate increases and volatility, but both relative to the market and in most cases absolutely to their target returns, they performed well. However, we recognize that any changes to performance for investors can place pressure on their personal situations, So while we feel positive about performance in this environment, we are sensitive to the impact of any unexpected lower returns can have to our clients. The type of environment we saw in 22 required a response to avoid the negative impact where possible and protect investment capital. However, once some of the early noise is better understood, there are usually opportunities that can be found for the future of the strategy. So while our funds definitely weren't immune to these markets, we made changes throughout the year and continue to do so to better position the funds going forward. While we continue to expect some volatility in the first quarter of 2023, we do believe that there have been and will be emerging opportunities. Now, obviously, with 6 distinct fund mandates, the strategies for how to deal with these markets varies within each fund rather than an overarching approach. But generally speaking, we reduced exposure to traditional fixed income early in 2022, which helped contribute to the outperformance of our fixed income pool relative to the market. We did, however, start to re-enter the traditional space towards the latter part of the year, as the increase of interest rates means there are opportunities to invest in higher paying bonds. We plan to continue to do so here in 2023. We also took the opportunity to continue to focus the non-traditional equity pool towards 2 primary mandates of private equity and real estate, and sold off some of the positions that had a greater private debt composition. While some areas of the real estate market came under pressure in 2022, such as office space, opportunities did present themselves, and we increased exposure to investments characterized by income flows, and particularly ones focused on high turnover markets or non-rent controlled properties, which allow for more frequent reset to rent or leases. This is particularly critical when you see the recent CMHC report that shows vacancy rates in the GTA for the condo apartment markets are 1.1% and purpose-built is 1.7%. But most telling is that units that turned over during the year saw their change in the rent of a 2-bedroom apartment increased by 29%. This makes a significant impact on the maintenance and improvement of property valuation and cash flow. Further to this, we continue to like asset-backed investments and began investing in the marine industry, where we are making an investment that is focused on leased barges in the US intercoastal waterways and the Mississippi. This strategy is a complement to our exposure to the recovering aviation industry, where we invest in aircraft leasing with our partner. Finally, in the last quarter of the year, we launched a separately managed account structure, the Capstone Canadian Income Strategy. This was to provide clients with access to a structure that would allow them to benefit from planning and giving opportunities, but also to take advantage of markets that were performing poorly by providing a strategy focused on adding alpha to the equity markets moving forward. Overall, our funds held up well in the face of a very challenging market. We believe there are opportunities to make money for investors in all markets, and these volatile times can provide opportunistic investments that our funds can take positions in for the future.
Glenn, let's shift gears and talk about Capstone's 3 mortgage funds. Can you comment on what you see going forward in the mortgage lending space?
Sure, I'll take a similar approach to the inflation question by focusing on what we do know as a way to understand some of the platform for the coming year. The interest rate increases during 2022, along with the inflationary pressure on the cost of construction, definitely provided headwinds to the construction industry and therefore the construction financing market. However, a number of issues surrounding the inflationary impact to cost started to come down in the latter half of the year. For a lot of the back half of 2022, though, these pricing decreases weren't being fully represented in cost consultant reports, which often required more borrowing or equity from the developers. We expect that these will be better reflected in 2023, which should ease some of the pressure on projects. In reviewing the year-end data from the Toronto Real Estate Board, it showed some flattening of monthly sales data and price trends, which had been coming down significantly since the peak in February. This newer trend may indicate the beginning of a stabilization of the market. Part of this flattening could be a result of the significant drop we've seen in new listings which sits well below the 10-year average for December, compared to 2020 and 2021, where we were comfortably above that. This decline in listings will only increase the continued supply shortage for both home ownership and rentals, which will continue to provide a level of support to the market. As an example, the Canadian rental vacancy rates for purpose-built rentals was 1.9%, and for condominiums was 1.6% according to CMHC, which was a decrease from 2021. We also believe that the government's immigration policy will provide additional demand for housing, which will only increase supply shortages. In addition, the most recent government actions like foreign ownership restrictions will not have a significant effect on the market demand, particularly in BC and Ontario, which already had foreign ownership taxation. Importantly, with the likely pause of interest rate hikes by the central banks, there's a platform now for a more informed decision-making environment, which should generally help the market. And impactful to our funds, it would allow developers to have some increased certainty to the cost of financing. In fact, even while we have all the media discussion about the pressure on variable rate mortgages and the knock-on impact to the market, it should be noted that the 5-year rate has been coming down, with rates now below 5% with some financial institutions. This definitely doesn't mean all the issues have been sorted, as I expect the first quarter will still be uncertain. We always reassess key areas such as employment, interest rates, the economy's health, particularly with a potential for a recession, and then market supply. Specifically to the funds, we did take a defensive posture in the second half of 2022 to ensure that we kept the funds healthy. By defensive, I mean we took allowance on portfolio for uncertainties and were cautious with financings that we were making. And the ones that we did commit to subsequently did take longer to close as the financing market became tighter. This definitely impacted performance over the last half of the year, but does put the funds in a better position as we enter 2023. With better visibility into the rate environment, the fund capturing higher interest rates on our variable mortgages and growing pipeline of opportunities, the funds are positioned well to capitalize in 2023. Overall, the factors I've been discussing regarding supply and demand, along with some of the improved rate visibility, could provide a more balanced market when combined with some of the ongoing risks ahead. So we enter 2023 with a cautious but positive outlook compared to 2022.
This is a very interesting environment we find ourselves in. What would be your investment strategy going into 2023?
It's an interesting question considering I oversee the management of a number of funds. So I would say our funds are good investments to be included in anyone's portfolio. However, to highlight a few, which and some I've already mentioned, I do think with the significant rise in interest rates last year, it makes the traditional bond markets a good opportunity for accessing performance, as you will be buying into higher rates and potentially capital growth if rates come off to any degree in 2023, as we've already seen a little movement in that area at the start of this year. It wouldn't take too big a move down with the current interest rates on the bonds to quickly outperform GIC rates. Further to this, if you have a longer time horizon, then there may be good opportunities to get into the traditional market in 2023, particularly when you consider some of the high dividend rates available. Our equity income strategy has an approximate dividend yield at the end of the year of 4.4%, which is a good starting point for performance. Are there going to be headwinds from corporate earnings in 2023? I do expect there will be buying opportunities this year to establish a portfolio for coming years. Finally, despite all the negative media noise about real estate, there are opportunities in the market. Real estate is a very broad term, and there are areas we have seen good performance in 2022, which contributed to our non-traditional equity pool and significantly outperforming traditional equity markets with an over 5% gross return. As mentioned, we have seen our income producing properties performing well, especially those in high turnover sectors or properties in markets with no rent control, that they can then capture the increasing rental rates. Our hotel investments in Whistler have come back very strong, with revenue and valuations now above pre-pandemic days. So the key, in my opinion, as always, is to build your portfolio with a balance of investments in both traditional and non-traditional holdings.
And finally, Glenn, will Capstone be launching any funds in 2023 that we can look forward to? And can you give us a preview?
Sure, we definitely are. And it's looking likely to be the busiest for launching new funds for Capstone. So currently we have 3 new funds that we are working to launch in the first half of the year. But until they're actually launched, things can always change. Having said that, we're excited about the direction that we are moving with these offerings and believe they are complementary to the funds that we already manage and align with the mission and vision at Capstone. So a quick overview. Firstly, the Capstone Kinvest Impact Fund. We've been talking about this a little bit in other video calls. Is currently taking expressions of interest now, looking towards a potential close in the second quarter of 2023. This is our first impact focused fund, and we're partnering with Kinvest to bring this to market. A few highlights: it's an agricultural impact fund investing in Rwanda. The fund will be acquiring or leasing approximately 600 hectares of land that will be cultivated and harvested by the local surrounding communities in conjunction with Kinvest. The goal here will be to provide employment, training, and a sustainable economic engine and market, then ultimately roll 80% of the ownership into the hands of the workers. It will be a 10-year closed-end fund with an annualized target performance of 12% plus. Our second fund is the Capstone Treasury Fund. This fund will provide investors with a high interest product with daily liquidity to meet the needs of both individuals and organizations. Essentially, the objective will be to provide a competitive interest rate based on the current interest rate environment, while providing liquidity to investors for working capital or short to midterm savings needs. The third fund being worked on is planned for a mid-year launch and is being developed in conjunction with a couple of organizations to support the extension fund community in Canada by providing financing to faith-based organizations. It is still a little premature, so we'll share more information on this investment opportunity at a later date. Finally, I really should mention again the separately managed account offering that we launched in the last quarter called the Capstone Canadian Income Strategy, which is focused on Canadian dividend stocks and adds a biblical informed overlay to the fundamental research analysis within its investment selection criteria.
Thank you, Glenn. It's always a pleasure to speak with you. And to our audience, thank you for your interest in this update. If our team at Trinity Family Wealth Advisors can be of additional service, please be in touch with us. Thank you for your time.